told your friend you're not okay, and tell me what's wrong and why you never said you felt that way. Guess you're trying to stay strong and
Are you looking for ways to grow your business? Are you interested in investing? Are you seeking a method to manage your money and maximize your savings? If so, ratios are one of the bases you should start with. Calculating ratios is often one of the most frustrating aspects of high school math. However, it doesn't have to be this way when it comes to investing. A good understanding and application of certain ratios can help you become a more informed investor. Having a good understanding of financial ratios is essential to adding analysis. Hello guys, welcome to my channel. Based on fundamental analysis, a security's true value can be assessed and compared with its market value. In this video, I will break down 7 financial ratios often used to pick stocks for investment portfolios, as well as why they are valuable. Number 1, quick ratio, a measure of liquidity. The quick ratio is also known as the acid test. It represents a company's ability to pay current liabilities with assets that can be converted to cash quickly. In order to calculate the quick ratio, you divide current assets by current liabilities, minus inventory, and prepaid expenses. The formula removes inventories since liquidating inventory takes time. Let's say company A has 10 million in current assets, 7 million in current liabilities, 3 million in inventory and prepaid expenses. That means the quick ratio is 1. In other words, it means the company has enough money to pay its bills and keep operating. The quick ratio of less than 1 indicates that there are not enough liquid assets to cover short-term liabilities. Raising capital and taking other measures may be necessary for the company. Still, it is possible a temporary situation though. 2. Working capital ratio. In order to determine the health of a company in which you are interested, you need to measure its liquidity. The liquidity of a company refers to its ability to convert assets into cash to meet short-term obligations. You can measure liquidity by using the working capital ratio. Liquidity is measured by the ratio of current assets to current liabilities, which is known as the working capital ratio. The working capital ratio is calculated by dividing current assets by current liabilities. Let's say company A has current assets of 12 million and current liabilities of 4 million. In this case, the working capital ratio is 3. This indicates a strong short-term liquidity position. When a business has a higher working capital ratio, it will be easier to pay off its debt using its current assets. In contrast, if 2 similar companies each had ratios of 3, but one had more cash among its current assets, it will be able to pay off its debt more quickly. Having a working capital ratio of 1 can suggest that a company is having liquidity problems and may not be able to pay its short-term obligations. This might only be a temporary problem and resolve itself with time. If the working capital ratio is 2 or higher, the business has healthy liquidity and can meet its short-term obligations. In addition, it may also indicate that the company has too much short-term assets, some of which could be used to invest in the business or pay dividends. In order to determine a firm's ability to meet its short-term commitments, determine the appropriate category for the vast array of assets and liabilities on a balance sheet can be challenging. Number 3. Debt-to-equity ratio. Would it be wise to invest in a company that borrows too much? The result can be an increase in fixed charges, a reduction in earnings for dividends, and a risk for shareholders. A company's debt-to-equity ratio determines the extent to which it is borrowing money to fund its operations. The equity in a company can indicate whether all debts are covered if necessary. Comparing leverage across companies in the same industry is a common way for investors to make informed investment decisions. As a result, they can determine which investment is lower risk Divide total liabilities by total shareholders' equity to calculate the debt-to-equity ratio. Consider Company A, which has loans of 3.8 million and shareholders' equity of 16.5 million. Therefore, we have a modest ratio of 0.25, which is acceptable under most circumstances. When the ratio is greater than 1, the company has more debt, and it indicates that the company has less debt if the value is below 1. The metric, however, has to be analyzed based on industry norms and company specifics, as all other ratios are. Number 4, earnings per share. Stock purchases involve the participation in the company's future earnings. The earnings per share of a company are a measure of its profitability. This helps investors determine a company's value. To calculate EPS, you must divide net income by the number of outstanding common shares during the financial year. A company with zero or negative earnings will also have a zero or negative earnings per share. An increase in earnings per share indicates greater value. Number 5. Price-earnings ratio. Investors use this ratio to assess a stock's growth potentially. It represents how much they would pay per dollar of earnings. In most cases, it is used to compare the potential value of a number of stocks. P/E ratio are calculated by dividing the current stock price by earnings per share. For example, a company closed trading at 43.32 a share, and the EPS for the past 12 months averaged 5.32. Then the P/E ratio would be 8.14. An investor would spend $8.14 for every dollar of annual earnings generated. Some investors have paid more than 20 times the EPS for certain stock when they believe the future earnings growth will yield a reasonable return on their investments. When a company's earnings are zero or negative, the P/E ratio makes no sense. It will show as not applicable. Investing results can be improved when you understand and apply ratios correctly. Number 6. Return on equity. Profitability and the efficiency with which a company uses shareholder money to make a profit are measured by return on equity. Shareholders of common stock calculate ROE by dividing net income by total shareholders' equity before and after paying dividends to common stock. Let's say Company A's net income is 3.3 million. Its shareholders' equity is 10 million. ROE then is 33%. A company with a higher ROE will be more successful at generating profits from shareholders' equity. How do you determine a good return on investment? The return on equity metric is used to analyze investment returns. It is a measure of how well a company generates income from shareholders' equity. A good ROE might be one that increases steadily over time. This could indicate that an organization uses shareholders' funds effectively to increase profits. Therefore, shareholder value increases. The value of the fundamental analysis lies in the fact that by comparing a security's true value to its market value, an investor can decide whether the security is fairly priced, overvalued, or undervalued. Which is better, a higher or lower P/E ratio? Investments comes in a variety of forms. P/E ratio measures a stock's price in relation to its earnings per share. Lower P/E ratio indicates that a stock may be undervalued and therefore worth buying. This could be due to the company's poor financial health too. Stocks with a higher P/E can indicate that they are expensive, maybe overpriced. But this could be also due to the fact that the company is doing well. You can use P/E ratio as a tool for comparing the relative values of stock that interest you. Another option would be to compare the price to earnings of several stocks to the industry average. Number 7. Profit margin. Profit margin is one of the key financial ratios to be aware of when it comes to profitability. This indicates how efficiently a company manages its costs or how well it converts revenue into profit. Here is a formula. To convert the result into a percentage, multiply the result by 100. A company with a higher profit margin converts sales to profit more efficiently. For a comprehensive view of a company's financial health, Most ratios should be viewed in conjunction with others rather than individually, but you do not have to consider them all. The key financial ratio can be choosing to gain a greater understanding of a company's potential by picking and choosing the most relevant ones. Alright guys, thanks for watching. That's all for today. If you enjoyed my video, please drop a like button. If you like my content, please subscribe to my channel for more future videos. I will see you next time.
Died with a purpose, all the energy around me felt nervous, scared I would pop out fast to the surface. Had to cut it off before you made me worthless. Torn apart, I've been torn and scarred. I had a given art, but now I'm thinking smart. I'm keeping up my guard, I'm hiding every card. A royal flush of love, you never know what's hard. With a back to the Mac and a